Reserve's recent decision to implement a substantial interest rate cut has sent waves through the global financial system. Many people are asking, why now? And what does this mean for the US economy? For investors, homeowners, business owners, and everyday Americans, understanding the significance of this move is crucial. First, let's talk about what an interest rate cut means. Interest rates are essentially the cost of borrowing money. When the Federal Reserve, or the Fed, raises interest rates, borrowing becomes more expensive, making people and businesses less likely to take on loans for things like homes, cars, or business expansion. On the flip side, when the Fed cuts interest rates, borrowing becomes cheaper, which can stimulate economic activity. The idea is to make it easier for consumers and businesses to borrow and spend, boosting the overall economy. So, why did the Fed cut interest rates now? And why was this cut so significant? The US economy has been facing several challenges recently, with signs of slowing growth, higher inflation, and ongoing geopolitical tensions. In particular, inflation has been a big concern. In this context, the Fed's rate cut is intended to address these issues. Lowering interest rates is a tool the Fed uses to make borrowing cheaper and to encourage spending. When consumers spend more, businesses tend to see increased profits, which can lead to more hiring, more investment, and generally higher levels of economic growth. But there's a delicate balance the Fed has to strike. If you're a homeowner or considering buying a house, this could be good news. Mortgage rates tend to follow the Fed's lead, meaning that with lower interest rates, mortgage payments may go down. For businesses, particularly small businesses, this could provide a lifeline. Many small businesses rely on loans to expand, buy inventory, or even just keep the lights on during tough times. With lower interest rates, these loans become cheaper, which could help businesses maintain cash flow and continue operating. Investors are also paying close attention to this rate cut. Stock markets tend to react positively to lower interest rates, as they make it cheaper for companies to borrow money to invest in growth. However, it's important to remember that the stock market is unpredictable, and while lower rates can boost stocks in the short term, the long-term impact will depend on whether this move by the Fed succeeds in stimulating sustainable economic growth. Of course, there are risks involved with such a significant rate cut. One of the biggest concerns is inflation. While the Fed's rate cut aims to boost spending and economic growth, it could also lead to higher inflation if the economy overheats. Inflation erodes the value of money, meaning that while you may earn more, your money doesn't go as far because prices for goods and services increase. If inflation starts to rise too quickly, the Fed may be forced to reverse course and raise interest rates again, which could put the brakes on the economic recovery. Another risk is that the rate cut might not be enough. The Fed is using interest rates as a tool to try to prevent a deeper economic downturn, but it's not a guarantee that this will work. There are other factors at play, such as global economic conditions and political uncertainty, that could dampen the effects of this rate cut. If businesses and consumers are still too uncertain about the future, they might not increase spending, even with lower interest rates, which would make the Fed's move less effective. It's also worth noting that interest rate cuts can have a ripple effect around the world. Because the US dollar is the world's reserve currency, a change in US interest rates can influence global markets. With this move, the Fed is sending a strong signal that it's willing to do what it takes to support the economy. But it's also reminding everyone that monetary policy alone can't fix all of the challenges we're facing. For a full recovery, we'll likely need a combination of fiscal policy, business investment, and consumer confidence. Thank you for watching. If you found this video helpful, don't forget to like, comment, and subscribe for more updates on financial and economic trends. Hit the notification bell so you never miss an upload